Hello, and welcome to Essentials of Management Corporate Strategy. My name is Stefan Lippert from the Kenichi Omai Graduate School of Business in Tokyo. Let's get started with an overview of the course. The course is divided into 4 parts. First, part 1, we take a strategic overview. So we talk about leadership, strategy, and competitive advantage. And then in part 2, we do a strategic analysis, which contains 2 major parts. One is the external environment, opportunities and threats, so the market perspective, and then the internal environment, the internal resources, so the organizational perspective. This is the homework, analytical homework we have to do before we move into part 3. Then part 3 is about strategy formulation. And we will look at strategy formulation at 3 levels: at the functional level, at the business level, and at the corporate level. And finally, part 4 is about strategy implementation. We look into the performance and governance issues. The course is based on the textbook from Hill and Jones, Theory of Strategic Management. Part 1, Strategic Overview. Question number 1. Why do some organizations succeed while others fail? The key is strategy. How can we define strategy? Well, there are several definitions available. Here in this course, we use a rather broad definition. Strategy is a set of related actions that managers take to increase their company's performance. So this definition contains 3 parts. First, it's about managers. Managers take action. So it's about leadership, strategic leadership. Strategic leadership is about managing the company's strategy making process. Then it's a set of actions. So we need to know what we are going to do. We need to determine and select a strategy. That's strategy formulation. And finally, we need to do it, actually. We need to implement it, so that's strategy implementation. The measurement of success is profitability and profit growth. So a company that has a superior performance is a company that outperforms its peers in the industry in terms of profitability and profit growth. Profitability is not profit or income on sales, because think about a company that has a huge asset investment, a huge factory. Let's say they invest 100 million into the factory, they make 1 million in sales and 500,000 profit. That would be very profitable, 50%. But in terms of return on investment, it would be a disaster. So we have to look here at ROIC, return on invested capital. ROIC is defined as net profit divided by capital invested. So net profit is the net income after tax, so what you actually get, the bottom line. And capital invested is equity plus debt to creditors. If a company outperforms its peers in the industries, its peers who compete for the same customers, it obviously has a competitive advantage. We say it's a sustained competitive advantage when a company's strategies enable it to maintain an above average profitability for a number of years. So if you look at the determinants of shareholder value, so it's measurable, it's profitability, return on invested capital, and it's profit growth.